Welcome to Numera Analytics webinar entitled The Market's Blind Side. Big welcome to Joaquin Kritz-Lara, our head strategist. Hello, Joaquin.
Hi, how are you?
Good, thank you. Before handing it off to you, I think it's important to set the stage. There's been a lot going on from a global macro perspective over the last few months. Obviously, the overwhelming topic of conversation has been the beginning of the Fed easing cycle. Clients are asking how fast, how much will they do? Market continues to expect aggressive cuts for the remainder of 2024, and with a total of 7 cuts leading into half year next year. We have been cautioning clients that fund Fed expectations can change quite aggressively. You don't have to go as far back as December of last year when markets were expecting 6 to 7 cuts in 2024. That changed very quickly in Q1 of this year when there were whiffs of inflation that dropped those expectations to 1 to 2 cuts. We have gone full circle, and here we are with the help of weaker employment numbers, with inflation closer to Fed fund targets. We are back to aggressive cuts leading into 2025. Throughout the year, the focus has gone from inflation to employment, but there remains very little focus on growth as markets expect some kind of soft landing or potentially even no landing scenarios. Do we actually get some kind of growth scare or what our clients are asking? If we do, does that change our overweight position stocks relative to bonds, growth relative to value? And what else should we be looking out for? And finally, we will be answering questions at the end of this webinar. If you will be prioritizing clients, of course. If we do not get to your questions, we'll make sure to email you after the webinar as soon as possible. And I will hand it off to Joaquin. Thank you.
Thank you, Chris. Thanks for the intro. You're absolutely right. The emphasis throughout the year and certainly in the last month and a half has been around, the speed, magnitude, and length of the Fed easing cycle. Some other central banks have already, started cutting rates even earlier as economic conditions in other developed markets started to stagnate, inflationary pressure ceased, and so on. It's now the Fed's turn. Powell signaled this ahead of last week's cut at Jackson Hole. And over the last month and a half, I'd say really since the July Fed meeting in particular, there's been an incredible degree of uncertainty around the reasons why the Fed would be cutting and how fast, again, that will come and what that means for asset positioning. And so these are the questions we hope to address today. For clients that follow us regularly, you'll be familiar with the structure of the today's session. I'm going to start off talking around focusing on our macro views, obviously with an emphasis around Fed policy, and then I'll move on to discussing sort of market implications and what it means in particular for asset positioning for multi-asset portfolios. So starting off, in thinking about sort of Fed policy and the outlook for the U.S. economy more generally, it's helpful to take a step back to where we were in mid-year. So throughout the first half of the year, financial markets were incredibly optimistic around U.S. growth prospects. They started pricing in again, as you mentioned, higher for longer Fed policy. And that changed abruptly in early August. It feels like it was a long time ago, but it really was a month and a half ago where we had the big volatility spike, which you can see here. So the VIX actually hit its largest daily increase outside of downturns. And that, as you can see in sort of tracked by that green line you see there, what the green line shows is basically it's a proxy of recession fears. It's internet searches around the term recession in the United States, and so that spiked simultaneously. And essentially, what happened in early August was that we had a pretty weak jobs report. The unemployment rate rose to a level that historically tends to precede or aligns with recessions. And so people started again worrying around a hard landing. But that sort of adverse sentiment very quickly dissipated. And we're now back in a situation where investors are generally very optimistic. The fact that the Fed is cutting has proven favorable towards risky assets. And the rapid recovery in risk appetite, I think, essentially reflects two forces. So what this chart here shows you, and I think it illustrates well what we've seen in the recent past, is a breakdown of the factors that have contributed to returns on tech stocks in the US so far this year. So this is a standard exercise we carry out throughout our publications. We call it a drivers decomposition. The idea is to use modeling techniques to effectively isolate the estimated contribution of various different factors, like, say, growth or growth expectations, currency movements, monetary policy, or investor sentiment, to observe changes in asset prices. So this is for the NASDAQ, so basically a proxy of US tech. The dots show you cumulative returns through early August, so right after the volatility shock, and the bars are where we are year to date. So in early August, there was a significant compression in sentiment, basically a normalization, which you can see from the very last red dot. And at that point, most of the returns that you had seen, that you had so far, that you had seen year to date, were essentially explained by fundamentals and primarily around, robust growth perceptions. At that point already, by early August, the market had started pricing, greater Fed support, although perhaps not to the extent that it did throughout August. And so that contributed a little positively towards Fed policy as long-term yields started diminishing. But the big change came after. So in the last month and a half, we've seen a significant resurgence in sentiment that has, again, been allowed for by the fact that even if job market conditions are slowing, spending remains quite resilient. And so that basically tones down fears around a hard landing. And B, by the fact that the market is now expecting a very rapid easing cycle. What's important here to understand, I think, is that the market is pricing a lot of Fed support without a recession. And it's that combination that is favorable towards riskier asset classes. A good way of illustrating this is by looking at sort of the evolution of the bond market or of Treasury yields in the recent past. So what this chart here shows you, it's basically a similar exercise to what I just showed you with tech stocks. This is for the 10-year yield. So it shows you cumulative changes since the July FOMC meeting. And when you think about the evolution of long-term yields, they're essentially a function of expectations around Fed policy, growth and inflation, and any other factor that may drive supply and demand of bonds in the secondary market. So risk appetite or risk perceptions will widen or compress the so-called term premium that investors demand for holding long-term debt until maturity. And if you break down the change in yields since the July meeting, the vast majority of the drop that we've seen in yields, which is quite sizable, it's over 50 basis points, is accounted for by two things. The fact that the market is pricing a faster Fed easing cycle. Chris mentioned this idea that the market was pricing 7 additional cuts, so on top of the 2 that have happened so far. And so we have 9 cuts going into the June 20, into basically the summer of next year. But then what I really want you to focus on is sort of the balance between growth and inflation, right? So growth expectations have essentially remained unchanged. So there is nothing that, there's no inherent fear around the possibility of growth slowing down. And that's also been fed by the sort of last week's Fed meeting. If you look at, in particular, the summary of economic projections, if you look at things like the Fed's projection for GDP growth or even the unemployment rate and the neutral rate of interest, they're all quite high, right? So it's not like the market that, the Fed is expecting a slowdown, and that obviously feeds into market expectations. If you continue to see things like consumption growing 4 or 5% annualized, that definitely is keeping growth expectations elevated. So what really explains the bulk of the drop is not so much concerns around growth. That's not it. It's this idea that the market believes that inflation risks are essentially a thing of the past, right? So because they're no longer worried around inflation, break-even inflation rates have gone down dramatically. Say if you look at 1 year ahead break-even inflation, right now it's near 1.5%. That means the market is expecting inflation to average, way less than 2% over the next year. And so in a context in which inflation is dissipating, to the extent that the bond market thinks that Fed policy is contractionary, the perception is, okay, they're just going to bring down rates quickly back to neutral because there's no more trade-off in place. Even if this is the case, though, the amount of Fed support that's currently being priced in is remarkably strong relative to past easing cycles. This is a chart that I think illustrates this point well. What the horizontal axis shows you is the expected number of cuts that were priced ahead of a Fed pivot in the last 3 decades. So starting in 1989, we had, hard landings and soft landings. 95 and 98 were very favorable. 2000, 2007, and even 2019 were not. But what you can tell is that the yellow dot, which is where we stand today, is really an outlier, right? So typically at the start of, or right before the start of Fed easing cycles, the bond market prices anywhere between 3 and 5 cuts at most. In 2000, it was pricing 5, a little under that. But, generally it's, very modest expectations of Fed support. Today we're at 9. And if you focus on the vertical axis gives you a proxy of the strength of the job market. So what we're tracking there is job openings or vacancy rates. What we're using is sort of the reported vacancy rates, or the share of unfilled positions at small and medium enterprises. The reason we're doing that as opposed to using the broader BLS measure is that one starts in 2000, whereas we can take sort of the surveys for smaller companies, which the reality is they employ around 70 or 80% of workers in the US. That dates back to the early 80s. And so we can do a much, we can go back in the past with the analysis. And so the higher the number of unfilled positions, essentially the tighter the job market is. So yes, it's true that, things like the amount of vacancies per unemployed worker have gone down or normalized versus where they were a year or 2 years ago. But the degree of market tightness is much higher than it's been really at any other point or at any other instance in which the Fed started its easing cycle. So it is, at a minimum contradictory that the market is pricing so many more cuts in a context in which job market conditions are not super soft in the same way they were, for example, during the Bear Stearns episode in 2007, right? So at that point, you had very soft job market conditions already. Obviously, they softened even further, and the market was pricing way, considerably less cuts. And so this definitely creates, some kind of mispricing in our view. In particular, I think the point to consider is that, beyond looking at things like vacancy rates, yes, it's true that job creation is slowing. And so generally when job creation slows and the unemployment rate rises, there's a greater incentive to cut. Even if this is the case, by many other measures, the US economy continues to overheat. For example, if you look at the amount of job destruction out there, so layoffs, those are super low still. That's in gray here. So that shows you the initial unemployment claims. Those are extremely low. Obviously, the Fed focuses on labor market conditions, not on growth. But if you were to look at growth, private consumption, so adjusted by inflation, so in real terms, is growing. In the last 3 months, it's grown at 5% annualized. That's like way above trend, right? That's not typically a situation in which you cut aggressively. And if you focus on inflation, headline inflation has gone down. A lot of that has been aided by a significant decline in gasoline prices. But stickier portions of the consumer basket are still quite high. So for instance, what the green line here tracks is core service inflation. So that's services excluding energy services like electricity or heating. If you remove those two, that gives you basically the stickiest portion of the consumer basket. That's running at at nearly 5% still, right? And again, that's not a situation in which you cut very aggressively, unless, of course, you believe that you're going to end up in a situation where even if the economy doesn't slow down all that much, inflationary pressures are going to continue falling quite drastically. And this is one of the key points that we've been emphasizing recently. We believe that the market is being overconfident around inflation risks in the near term. As I was saying before, the key reason why inflation has gone down has to do with things like gasoline prices falling, so it's quite transitory in nature. But what happens when the Fed starts cutting rates? When the Fed starts cutting rates, the dollar weakens. It's weakened about 5%. And that typically will fuel commodity prices. So this is a chart that we published a few weeks ago in our latest commodity outlook. What we looked at is we did an exercise where we tried to assess the impact that one interest rate cut by the Fed would have on expected returns on selected commodity prices. So a single rate cut, for example, increases energy prices or expected returns on energy by close to 3%. If the Fed were to cut 9 times, you can imagine that creates significant upward pressure on energy. And it does so naturally because the dollar weakens and there's an inverse link between commodities and the dollar. In fact, if the dollar were to weaken, imports in general would become more expensive. Another important channel of transmission is if you start cutting rates and mortgages drop, housing demand may rise. That puts upward pressure onto housing prices and by extension, perceptions around shelter inflation. And again, that creates stickiness at a minimum. Even if inflation doesn't reaccelerate, we just don't think that risks are as asymmetric as what the market is pricing in. So that's not a context. In fact, gasoline prices have already started reaccelerating. We've seen oil go from 68 to 75 today. And that's, again, not a situation in which you cut very, very aggressively in, at least in the near term, right? And so what this chart here shows you is a comparison between our latest forecast for Fed policy. That's the red line is the baseline. Everything surrounding it is basically the amount of uncertainty around the base scenario. And then we're overlaying that with the latest Fed funds futures curve. This is from the beginning of the week. It changed a little bit. It's changed a little bit since Monday, but it's basically the same type of pattern. So the way to read this would be as follows. In the near term, so between now and say mid-25, the market, we believe, is pricing in way too many cuts, right? So it's not impossible for rates to fall by 200 or 150 basis points. It's unlikely in the current macro environment. So in that situation, what we're basically expecting is, yes, we're expecting the Fed to cut, but a more modest pace, at least within the next, say, 6 months or so, in which the economy will likely continue to overheat or at least not stagnate or enter a downturn. But then if you focus on the other end of the chart, if you look at the green line plateaus at basically 3%, and that's the Fed's estimate for the neutral rate. So the terminal rate that the market is pricing essentially equates to the Fed's neutral rate of interest, which is about 3%, a little under that. We're expecting a much lengthier easing cycle. And what that sort of differential is picking up by 2026 in particular is this idea that the market is overconfident around growth. So in the near term, there's overconfidence around inflation. Longer term, there's overconfidence around growth. This is something that Chris was asking at the beginning of the session. And let me sort of illustrate our views on growth. Perhaps not in the near term, but in 2025 and 26. By far the biggest factor that has supported growth, spending in particular, in the last couple of years at least, has been an incredible expansion in household balance sheets or household net worth through exceptional support during COVID. So what this chart shows you, for example, is it tracks basically the performance of liquid and not so liquid assets. So this is basically cash held by consumers and financial assets relative to spending. And you see that they really spiked up early in the pandemic. So this is what people talk about so the green line of cash would be what people talk about excess savings. So this would be discretionary fiscal support. But then you see that this has gone down. It doesn't mean that it can continue going down, but if you're back to trend and it keeps going down, it just means that you're literally dissaving, right? So you're saving less than you would in normal circumstances. So the point is that moving forward, there's less support from sort of this significant expansion in household net worth relative to what we've seen in the last few years. And so in that environment, for spending to remain very resilient, especially in a context in which job creation is slowing, households need to be comfortable with the saving, essentially, or unless, of course, labor market conditions were to remain very strong or strengthen even further. What we're sort of concerned that the market is underestimating in this respect is that perceptions around job security, which are typically the key driving force between the decision to save or spend, those are going down as demand conditions normalize. So you can see this illustrated here. What this compares is hiring needs by small and medium enterprises, which is a proxy of demand. Again, it's gone down. It's not at dramatically low levels, but it's, you're not in the same situation you were a year or 2 years ago. And that typically affects perceptions around job security. So the blue line comes from the Conference Board's consumer confidence survey. It's a subcomponent where people are asked, do you think that it's easy or hard to find a job? And usually this is the measure that typically will guide the decision to save or spend. So the point is that if labor demand conditions continue to weaken, people will be less willing to spend, their net worth. Given that credit conditions are quite tight already, it's going to become increasingly challenging to maintain a high level of spending. So when you map that into our growth views for the US, and I'll show that to you here, this is our updated forecast for GDP growth in the US over 2025-26. So the way to read this is, again, another typical chart that we'll show in our research. Our emphasis is around probability forecasting. So we're not just interested in understanding the most likely outcome for something. We seek to assess the likelihood of certain events materializing, because obviously there's an uncertainty around the future, and certainly when you think about asset prices, but also economic concepts like GDP. So the way to read this would be as follows. The Fed and the market in general, if you look at sort of the last survey of professional forecasters, for instance, they're expecting growth of about 2%, which is maybe a little under trend in the next couple of years. That's not impossible, but we're picking up an 80% chance that growth is weaker than that. So the most likely outcome would be growth of around 1%. Below that, the probability is below 1 is still high at a little under 50%. But, deeply, deeply adverse scenarios are also not that likely. And so that's actually why, if you look at our forecast for Fed policy, let me just go back for a second, you see that, it plateaus at a little under 2%. So it doesn't go to zero by 2026 or 2027. And again, it doesn't go to zero because we're not picking up this huge probability of a deep recession. So our sort of, the highest probability outcome is one in which, the economy loses momentum and stagnates. It's not disastrous, but it's worse than what the market is expecting. And so that combination of, asymmetric inflation risks in the near term and growth risks in the longer term is one in which you can, it has major implications for asset positioning. And so I'll discuss this quickly. So moving on to, what this actually means for portfolio positioning. In the near term, as I was saying, we don't really see any evidence of an imminent slowdown in spending. For example, what you see here is we have these diffusion indices that we build in-house that are sort of proxy measures of business cycle conditions. What we basically do is we try and track or monitor the evolution of a wider range of indicators and look at sort of common movements. The green line is basically for the US. What this is generally saying is that, economic conditions are still quite strong, certainly much stronger than other developed markets. And so because the green line doesn't fall off a cliff usually, it tends to trend downwards. We're not finding, a risk of an imminent slowdown that would trigger a risk-off episode. So in that kind of environment, risky assets still usually outperform. For example, what this shows you is the historical evolution or performance, really, of small caps. This is the Russell 2000 in the year after a Fed pivot. The blue line is the average performance since the 1980s. So it looks at the last 10, say, Fed pivots. And then you can see that it's very sensitive to economic activity, right? So if the Fed is cutting and there's no recession, small caps does really well. However, the Fed is cutting because conditions really deteriorate. Small caps, like other risky assets, will underperform. So the point is that as long as conditions remain resilient for spending, generally you will actually see macro optimism continue, and that should continue to support riskier assets. On the other hand, when you look at the sort of bond market outlook, it's essentially the opposite, right? So as long as bond market conditions, as long as growth remains resilient, the upside on high quality debt is limited. In fact, we've seen this already, right? So we started the beginning of last week with the 10-year trading at 3.7 or something. It's now gone up to 3.8, even with 2 cuts. And that's because the expectation is one in which people still continue to bet on the US economy. So what this basically shows you is our updated forecast for the 10-year yield. We run this late last week after the Fed made their decision, but it's broken down by investment or holding period. And so the way to read this would be, what's the probability that yields will be, say, below 3, between 3 and 3.5, between 3.5 and 4, between 4 and 4.5, and so on, over a given forecast horizon. The probability of that yields fall significantly in the fourth quarter are low. So actually, it should read Q4 24. We've obviously gone through most of Q3. The probability that yields, trade within the 3.5 to 4% range, which is where they are today, is the highest in the near term. In fact, by December, we actually are picking up at something like a 60% chance that yields actually rise at least marginally. And so, again, essentially, in that environment, you don't really want to be overweighing high quality debt. But if you look at it further down the future, focus, say, on H2 25 or 26, the probability of observing much lower yields than today, say below 3%, rises dramatically, right? So between Q4 24 and 2026, it rises more than 5x that probability. And what's behind this is this idea that the market is overconfident around growth, right? So even if in the near term, the market will, probably adjust their interest rate expectations, at some point, growth is going to start surprising on the downside, and that will encourage a rotation back to safer assets. In that kind of environment, which is the one we expect starting in the second half of 25 and certainly in 26, quality and duration are what you want to be holding. Duration in particular, because not only is it very interest rate sensitive, but also because it's trading way, way below fair value. So for example, what you see here is the evolution of our 30-year Treasury yields against, an estimate of the fair value. So these would be sort of short-term rate expectations or expectations of growth, Fed policy, and inflation over the long haul, right? So the fact that yields are trading more than 1% above that number tells you that there's still quite a bit of upside for sort of long duration bonds in terms of their prices actually going up. If you just look at, inflation adjusted prices for high quality debt since 2022, since the Fed started hiking rates, their performance has been disastrous. But you would expect that as the easing cycle progresses, the risk reward balance improves. And so our point here is that as long as spending remains resilient, continue to favor riskier assets. But as you do see signs of a slowdown in spending, quality and duration become much, much more attractive. And then just before I close and hand it off to Chris, I just do want to raise some questions around sort of geographic rotation or regional diversification, not just between, the stock bond question, but whether the Fed easing cycle opens up opportunities in certain regions of the world or maybe some sectors. Obviously, in the last decade or even more, U.S. assets have done a lot better than international alternatives. That's created a significant home bias in the U.S. and even for foreign investors in increasing their or overweighing U.S. over the rest of the world. That continued in the first half of the year. So in the first half of the year, what this is, it's a driver's decomposition. This is for the relative performance of the S&P against the MSCI World ex-USA, so offshore stocks. In H1, the US outperformed by 10% almost. So a very significant outperformance. And if you break that down by contributing factor, beyond risk appetite, there were two important fundamental forces. One was the fact that the US was growing faster. There's also sector composition at play there. It's not just that the US grows faster, but because you have a lot more tech in the S&P, tech by itself is a segment where revenue growth is much stronger than in sort of older sectors of the economy. And so that amplifies the differential. And then a strong dollar, while generally unfavorable towards riskier assets, is worse for offshore holdings than it is for US equities. So in a context in which the US dollar strengthens, typically the US outperforms. That's starting to change. In the last 2 months, the dollar has weakened about 5%. The reason why this has happened, you can see it in this chart, has to do with the fact that expected interest rate differentials between other developed markets in the US have widened significantly. So basically, the market is pricing more aggressive Fed support than by other developed market central banks. And that caused the dollar to lose significant ground. And so when you look at offshore performance since mid-year, a lot of markets in dollars are actually posting stronger returns than the S&P. And it's really explained by the FX gain. But as long as that FX gain continues, then that at least opens up some opportunities for diversification. And in that spirit, obviously the risk reward varies across assets. In general, Fed easing cycles are especially favorable towards emerging market, both stocks and bonds, right? So, this chart here, I think, illustrates that idea. It's the same type of thing I showed you for small caps before, but I'm comparing across assets here. So this looks at the average return in the 12 months after a Fed pivot for various asset classes, the S&P, offshore stocks, DM bonds, and EM bonds, when Fed easing cycles coincide with a recession and when they don't. So obviously, when you have a recession, bonds will do better than stocks. But when you don't have a recession, riskier asset classes do better. And in particular, EM equities tend to do exceptionally well in that environment because there's risk appetite at play, right? So they do very, very well, usually. So the only context in which they wouldn't do well is if you have the Fed cutting and a global financial crisis, because obviously that will trigger a flight to safety and EM equities are exposed. But other than that, EM assets will generally do very well. And I'll close with this final point. You can sort of mimic that kind of performance at the sector level. Like, let's say you're an investor that doesn't really have a lot of offshore exposure, but you want to address the same kind of factors at a sector level. Certain segments of the S&P give you similar exposure to Fed cuts. Energy, for example, moves quite similar to emerging markets. We're picking up a very high probability that energy will outperform other value cyclicals. So what this shows you, for instance, is a 12-month projection for energy stocks today against non-tech cyclicals. The probability that it outperforms is almost 70%. That's very high by historical standards. And this, much like for EM equities, captures a high dollar beta, a fairly high interest rate sensitivity, and if you're comparing against other non-tech cyclicals, that sort of mitigates any downward pressure you may have from the U.S. economy slowing down. So just to wrap up, and I'll hand it on to Chris now, when you think about positioning the Fed easing cycle, it's really important to think about how you time it, right? How you think about sort of how the economy slows. And then it's not just about sort of playing around with your equity to bond mix. There's also very interesting opportunities that you could exploit by rotating regionally or even at a sector basis. And all of this that I've talked through today, this is all featured in our recent publications. Throughout the last month, I would say the vast majority of our research has focused around the topic of Fed easing and what it means for markets. And so if you are interested in learning more, do reach out to Chris or the rest of our sales team for that content if you haven't seen it yet.
Thank you, Joaquin. We have got a few questions. Is it possible to go back to your chart on our Fed fund expectations? I think it's page 8.
Yeah.
I think it's important because one of the questions has to do with tech stocks. As we know, tech is at least 30% of the S&P, and whatever happens to tech usually drives the overall market. So with a Fed easing longer than what markets expect, which is our view, how does tech react in such an environment? Does it continue to outperform, and should we limit our exposure?
Yeah, so I think that's a great point. Typically, if you look at sensitivity of various sectors or styles to rate cuts, generally tech is more reactive than most other categories. There's a few non-tech cyclicals that would be just as reactive, real estate, for example, but in general, tech is quite reactive. But much like the point that I made for small caps or other types of assets, the outperformance depends quite heavily on economic conditions, because tech is also quite sensitive to, broad-based macro conditions and perceptions around growth. And so the way we're thinking about tech is, especially in a context in which valuations, for the most part, are quite elevated, right? And so the way we're thinking about tech is selective overweights in the near term to benefit from the fact that the Fed is cutting, even perhaps not as much as what the market would be expecting, but prioritizing sectors within tech that have a very sound structural growth story. So software, for example, is a category of tech that we like a lot, because not only is it rate sensitive, but also, its earnings or revenue potential is much stronger than that of the overall economy, and depends on factors that would not be necessarily affected by a slowdown as much. So things like cloud computing, or a transition towards things like software as a service, for instance, allow, for very resilient and very strong growth in software spending. So in the US, for instance, if you look at software spend by businesses, it grows around 9% in real terms per year. That's way faster than the overall economy, and it's quite as cyclical. And so the preference with tech to us is, if you want to sort of benefit from the beta that you have to interest rates, choose sectors that have a very resilient and robust growth story. Semiconductors, for instance, is much less resilient, because semiconductors in general, purchases of chips, are very much tied to the overall global economic cycle. So if that were to slow because the US stagnates, the downside risk on semis or hardware, for instance, is much higher. And so in tech, we are, selective in our choice, as opposed to being, broadly overweight, as you would typically be in at the start of Fed easing cycles, as long as spending is resilient.
Thank you. We have another question about gold. Obviously, gold is now at all-time highs. Again, looking at this chart, if the Fed cuts to close to 2% rates, what does that mean for gold? Does it continue to outperform?
Gold has been a really interesting one. Year to date, it's doing really well. It's given, it's performed better than the S&P. And it's done so in a context in which the dollar, for the most part, has been strong, and interest rates, for the most part, have been high, right? What's driven gold so far is a combination of geopolitical concerns and, higher demand for gold. People talk about sort of the EM central bank story. That's definitely there. It's mainly China, really, shifting their exposure away from the dollar and towards gold as a share of their overall reserves. But it's actually Chinese private investors that, they're concerned about China's equity market, and so they're rotating to something else, and that something else appears to be gold. And so that's really what's been driving it so far. Moving forward, you gain additional sources of support for gold. You gain lower interest rates, which are generally quite favorable to gold, and you gain potentially signs of a slowdown or a stagnant US growth, which would typically encourage a rotation towards safer assets, including gold. So we're actually, even if it's trading at a historical high, we remain overweight on gold. In fact, if there's a near-term inflation scare, or the market were to revise upwards their inflation expectations, gold, like tips, let's say, would be a good hedge to that. So even if it's trading at high levels in nominal prices, we're still recommending going long on gold. The one caveat there is that the choice of instrument probably matters there. Obviously, you can do it you could just buy, a gold ETF. But if you're a hedge fund, let's say, you could decide to, buy call options on gold futures, for instance. The issue with using gold futures is that the forward curve for gold is really steep. And so the chances of you beating what the market is pricing, say 12 or 24 months down the line for gold, is more complicated. And so while we're long gold, we're saying, just bet on the spot price basically going up, as opposed to trying to time, the extent to which gold would go up versus an already steep futures curve, which is a much harder thing to do. So, a simpler choice as, a gold ETF, there's many out there, is a much better alternative.
Great. And just one last comment, Joaquin. What I've noticed in some of the questions is the massive overweight, relatively speaking, of emerging markets. So, if the benchmark is 7%, our weighting now is above 15%. So for our U.S. clients that just can only focus in the U.S., I think it would probably be a good idea in our research to kind of come out with something we can mirror or try to capture some of that alpha, but from a U.S. perspective.
Absolutely. And so we're going to be sort of exploring that sort of in the incoming weeks. But the gist of it basically is that emerging markets do well in Fed easing cycles, not because emerging market growth does better, but because it reacts to certain factors like the dollar or interest rates more so than other markets do. And so the whole point is you need to search for equity sectors in the US that have a similar factor exposure, basically. Energy has a similar one. There are certain industrial categories that would as well. And much like emerging markets, those in general, maybe excluding India, they're generally trading at very attractive valuations. Energy materials are also trading at attractive valuations, right? And so that is also something that, even if you don't have an EM exposure, what you want to basically do is mimic the factor sensitivity that EM has within the US equity market. And you can do this, right? Because there's lots of choices in the US equity market. So you don't absolutely have to, look abroad to benefit from those dynamics.
That's great. Well, this is the end of our presentation. Thank you so much, Joaquin. We will, whoever would like a copy of this presentation, just email us. We'll send it to you. And for sure, we'll do this again. This is great. Thank you to all the listeners. Have a great day.
Thank you.